Good morning, everyone. Welcome to our regional and agribusiness economic update on Wednesday, the 6th of July. My name is James Sheehan, Head of Business Markets in New South Wales. I look after the interest rates, FX and commodities risk advisory business here in New South Wales. Today, I'm joined by one of our team of regional and agri risk management advisors, Ethan Masters. Morning, Ethan. Hey, James. I'm also joined by Tapas Strickland. Tapas is Chief Market Economist here at NAB, providing commentary and insights to our clients on the economy and financial markets, including the regularly kicking off the working day with key overnight events on the NAB's Morning Call podcast. Prior to NAB, Tapas spent 6 years at Reserve Bank of Australia and also worked as an economic advisor to the Department of Prime Minister and Cabinet, advising the Gillard, Rudd and Abbott governments. Morning, Tapas.
Morning, James.
Today we'll hear from Tapas about key messages behind the RBA decision yesterday and what the economic outlook is during this tightening cycle. Following Tapas' presentation, we'll have some time for Q&A. If you have anything you would like to ask, please pop it in the chat box at the bottom of the Zoom. Over to you, Tapas.
Thank you. What a environment in terms of interest rates at the moment. You've got so much volatility in global markets, and you've also got high inflation occurring in Australia. With that kind of background, rates pricing is extremely volatile. The RBA obviously met yesterday, hiked by 50 basis points, and in our view, is likely to hike by another 50 basis points in August. Relative to what I would have said a couple months ago, and hopefully many of you were on this call a couple months ago, is we still see the cash rate peaking at around 2.6%. Markets are still pricing in a higher cash rate peak than that. Currently, they're expecting a peak RBA cash rate of around 3.5%. That has come down a little bit from what they were thinking only a couple months ago. And the real key reason why we still think the terminal cash rate peaks lower than where the market is thinking is just the impact that would have on the household sector in Australia if rates were to rise that dramatically over a shorter period of time. In today's presentation, I'll go through some of the reasons why we still think the RBA cash rate will peak at around that 2.6%. Relative to our forecast, there's a little bit of a risk that maybe the RBA cash rate peak is brought forward earlier towards the end of 2022, whereas our current forecasts have the RBA cash rate peaking in the middle of 2023. And really, the key observation to make is if the RBA cash rate needs to go above 2.6%, above where we are currently forecasting, it's really going to depend on that sensitivity of households. And at least in our view, households are going to be very sensitive to rising rates. In terms of markets and why market pricing is so volatile at the moment, and you just have to look at the 3-year swap rate in Australia to get some appreciation of that, is markets are very worried that central banks will over-tighten because they're trying to get inflationary pressures down, and their sole focus is currently on inflation. The other interesting bit of it is a lot of the inflation pressures that we're seeing is driven by global developments of which central banks don't have that much effect. The big one really being what's going on in Russia and Ukraine. And just to give you one headline, Russia and Ukraine are responsible for about 17% of the world's fertilizer exports. So food production is being impacted this year, it's going to be impacted next year. That's going to be persistent in terms of the inflationary process in Australia. Not much central banks can do about that. Risk assets accordingly are under a lot of pressure, and earnings profiles are likely to take quite a bit. And as I was saying, markets are definitely concerned that central banks are going to overdo the hiking cycle. So what you have seen over recent weeks is some consolidation in those longer term rates. The US 10-year government bond yield has gone from a peak of around 3.45%, currently trading around 2.85%. So quite a large move in terms of global markets at the moment. In terms of the Australian economy, I'm still very positive about the Australian economy. The key thing there to illustrate the unemployment rate is at 3.9%, the lowest since 1974, and job advertising in Australia is still 70 to 75% above pre-pandemic levels. That's even with an unemployment rate of 3.9%. All tells you there's a lot of labour demand occurring in the economy. In terms of where the rate cycle is going, I really like this chart in showing how market pricing has changed between today and 1 month ago. And just worth noting, market pricing has actually moved lower relative to where we were a month ago. And that's primarily due to those global factors that I was talking about risks that the market sees of central banks over-tightening and having to cut rates later on in the cycle. And indeed, when you look at market pricing is for an RBA cash rate of around 3.5% by the middle of next year. But then actually they're pricing in 25 to 50 basis points worth of cuts between then and the middle of 2024. NAB's forecast is that the RBA cash rate will peak a little bit lower at around 2.6%. And in the subsequent slides, I'll show you why we are still holding to that view that the cash rate will likely peak lower than what the market is currently pricing. A key reason is the interest rate sensitivity of households. And on this chart here, it shows you the housing sector interest payments as a share of household income under various different cash rate assumptions. If the RBA cash rate were to get to 3.5%, 3.75% in a relatively short period of time, as markets are currently projecting, that would see housing sector interest payments as a share of income at the highest levels since 2008. And if you cast your mind back to 2008, the type of economy that we're in a mining boom, and the economy also felt relatively weak for a lot of the eastern states, particularly in New South Wales and in Victoria. So we think that will be very restrictive to the economy that we're in. Our more mild peak in the RBA cash rate to about 2.6% results in interest servicing costs around the levels that we saw in 2011 and 2012. And we think that would be enough to restrain household spending to help assist get inflation back towards target there. The other factor is the impact that high rates have on the housing market. And we do know, at least in the capital cities, house prices are starting to fall. And in Sydney, they've fallen by around 3.4% since they peaked in the early part of this year. In regional areas, house prices rose by about 40% over the pandemic, and it's likely to see some reversal of that as rates rise. Just to give you some illustration of why house prices rose, you can fully explain the rise in house prices that we saw over the pandemic by how low rates got. So capital city house prices rose by about 26%. The interest rate cuts that we did see during the pandemic increased purchasing power by about 26%. So the marginal borrower borrowed up to the maximum borrowing capacity. Accordingly, as rates rise, theoretical borrowing capacity falls, and that's what this chart here shows. So using the 3-year fixed rate at the moment, which is currently hovering around 4.7% according to the RBA, but obviously fixed rates have moved a little bit higher since the RBA published that data, that would result in a 30% drop in theoretical purchasing power relative to 6 months ago. So for the marginal buyer who wants to buy something new, they are only able to borrow 30% less than what they're able to borrow just 6 months ago. So that's quite a large reduction in theoretical purchasing power. That would translate into the housing market as well. NAB's more mild cash rate assumption of the cash rate getting to 2.6% would reduce theoretical purchasing power by around 15 to 20%. And NAB's forecasts for house prices are for them to decline by around 18% over the next 2 years. Alternatively, if you were to use the market path, which is the RBA cash rate getting towards that 3.5, 3.75% in a relatively short period of time, that would see theoretical purchasing power decline in excess of around 30%. So we think the combination of high interest servicing costs and the impact on asset values likely means the RBA cash rate is likely to peak a little bit lower than what the market is currently thinking. And just worth noting, market thoughts on the RBA cash rate have also started to shift given those global growth concerns. Just worth noting as well, in terms of interest rate pass-through of higher rates, at the moment, around 37% of all loans in Australia are fixed rate. So that does provide a little bit of buffer for some households from a rising rate environment. But importantly, according to our book, and that's what this chart here shows, around 70% of all those fixed loans mature into December 2023. So we think we're going to get relatively quick interest rate pass-through. Just to put into context the rate rises that we have seen in the US has a 30-year mortgage rate system. So for them, they're not likely to see too much pass-through in terms of the consumer from higher rates. In New Zealand, they have a 2-year fixed rate. So they're only just starting to see the impact of higher rates through their household sector. The other area that's occurring is bank funding costs are rising. And just worth noting, the banking system received about 188 billion in very cheap funding at between 10 to 25 basis points from the RBA during the pandemic, and that has to be repaid in 23 and 24. Banks are starting to pre-fund that, and as a consequence, you're starting to see funding costs rise. And indeed, for those with surplus funds, you would have noticed a lot of the banks offering pretty attractive rates in term deposits at the moment. Part of that scramble for funding to replace the 188 billion that is going to be maturing over the next couple of years. In terms of bank issuance spreads, they've risen by around 50 to 75 basis points over the past year. So that's also adding to higher rates as well. And just very quickly, I just also wanted to cover off in terms of what's going on in global markets. And this is quite important in the sense that borrowing rates are set by market rates. And if you do get some consolidation in global yields, then you're likely to see some ebbing down in those rates as well. So just worth noting, the 10-year government bond yield in Australia currently at 3.55%, high since about 2014, but only just a couple of weeks ago, it was above 4%. So you have seen a lot of retracement in government bond yields as those recession risks rise. The main reason is central banks are so focused on inflation at the moment, and I'm sure you've seen various types of these charts before. It just shows you where core inflation is right around the world as a deviation to each central bank's target. So in the UK, core inflation is running 3.9 percentage points above target. So that's one of the main reasons why central banks are so aggressive and are hiking relatively aggressively to try and get inflationary pressures down. The other factor is there's a big political dimension. And during the recent election in Australia, housing costs, the cost of living was definitely a factor behind the election of the Labor government. That pales in comparison to the debate that we're seeing in the US, which is absolutely visceral. So President Biden's net approval rating has fallen precipitously, and at the moment is actually lower than President Trump when President Trump was voted out of office. The US government is giving a green light to the US Fed to get inflation down. Indeed, really needs to ahead of the next political cycle, which involves the midterms in November of this year and also the next presidential cycle, which occurs in 2024. If they don't get a crunch on inflation in the near term, then the Democrats are pretty shot in terms of their re-election chances. The theory amongst politicians is if central banks do over-tighten, better off having a recession now than closer toward that 2024 election. So that's one of the factors also why markets are fearing a recession.
I was just going to ask you a question about over-tightening. Is that typical in a cycle? Over-tightening is considered okay because it gives us room to come back?
In this cycle, it definitely is, because you'd have to say, at least from a central bank's point of view and from a credibility point of view, the risk for them is inflation remains high and remains entrenched, and they have to raise rates even further in order to reduce inflationary pressure. So they're happy they over-tighten now, because that probably saves them having to hike further if inflation gets more entrenched in the economy. The other factor just worth noting is some of the outside risks to inflation that have been prevalent more recently aren't in the control of central banks. So just worth noting in terms of Russia-Ukraine, that crisis, 3 observations. Wheat exports from Russia and Ukraine comprise around 26% of the world's wheat exports. So it's no surprise why food prices are high at the moment. Russia and Ukraine are also responsible for about 17% of the world's fertilizer exports. So crop production is going to be impacted next year, and importantly, it's going to be impacted not only in Russia and Ukraine, but also in many parts of the world, given that they export those fertilizers. And the final one is, and we're definitely seeing it in terms of the gas price, is just Russia and Ukraine comprise around 15% of the world's exports of petroleum oils. That's mainly affecting Europe, but it is leading to a very tight oil market at the moment. With inflation being relatively high, the big fear out of central banks, and this goes to your question, James, is inflation expectations rising and embedding a higher inflationary environment. That was part of the reason why the US Fed moved by 75 basis points in the early bit of July. It's also part of the factor for why the RBA has been moving by 50 basis point increments. And we expect the RBA to move by 50 basis points again in August. Importantly, we are starting to see the very, very first tentative signs that core inflation may be starting to peak. And this will be very important to monitor, especially for central banks. At the moment, or at least over the past year, it has been very expensive to ship anything. And to ship a container in Australia used to cost, $2,000. It got to about $10,000 during the pandemic. This chart here shows you container freight costs for a number of different routes right around the world, and just worth noting they have fallen quite sharply over the past. In fact, freight costs are back to where they were in the middle of 2021. I went to a recent freight presentation, and indeed for Australia, that shipping line was putting on another trade route into Asia. So it does look like the frequency of shipping and the cost of shipping is set to fall, and that would be relatively positive in terms of the inflation outlook. What's also driving a lot of the global growth fears is how consumers are reacting to this higher inflationary environment. And in Australia, consumer confidence has started to dip. That pales into comparison with the dip we have seen in the UK and the US. So consumer confidence in the US and the UK are at record lows. So consumers there are feeling that real income squeeze. Wages are rising, but not rising by enough to offset inflation. And they are definitely reining in spending. When you ask them, why are you reining in spending? Overwhelmingly, they say it's inflation. It's not necessarily because rates are too high. It's not necessarily because times are uncertain. It's all about inflation. So I think that plays to the view of central banks being very focused on inflation and why markets are fearing central banks are going to overdo the tightening cycle. That has important implications for risk assets, and obviously we have seen US equity markets sell off quite sharply since the beginning of the year. The S&P 500 down by about 20%. As you start to get markets fearing central banks over tightening, as you start to see bond yields fall, you may start to see some people think the bottom is in the US equity market. And indeed, overnight, you did see quite a big rally in the NASDAQ. So that may be a developing story in the second half of this year. But personally, I think it's a little bit too early to make that story. And we haven't really seen the potential impact of earnings downgrades in the US equity market. In terms of recession risk, NAB is calling for a US recession in 2023. So we are calling for a recession in the US. We also see a very high probability of a recession in the UK and the Eurozone in 2022 because of what's going on with energy prices there. So those recession fears are very real and are likely to drive a lot of that consolidation in global goods. In terms of the Aussie dollar, it's being buffeted by a number of different forces. The three key forces is what's going on with commodity prices, which remain relatively elevated, even though they have sold off over recent weeks. Global risk sentiment is pretty dire at the moment, and the Aussie has historically been a very big risk cost there. And also in terms of what's going on with the US dollar. The US dollar is very strong, and that's coming from a lot of weakness going on, particularly in terms of the euro at the moment. And you'd have to say, while we talk about the US economy potentially going into recession in 2023, currencies is all about a relative basis. And the US economy will outperform what's going on in the UK and in Europe. And that's part of the reason we have seen a lot of US dollar strength. So from an Aussie currency point of view, we should, for some time, the Aussie trading below 70 US cents. Currently trading around that 67, 80 level at the moment. And you can't really rule out further falls from here below a kind of 67-cent level if you do get further deterioration in risk sentiment as you get further fears of a global recession.
Just on that one, tap this quickly, the Aussie dollar. Traditionally, the RBA wanted a weak Aussie dollar or a lower Aussie dollar to build up their exports. What happens if we continue to see the Aussie dollar trade lower and lower? What would that have on inflation in Australia?
That's a very good question, and it would add a little bit to the inflationary impulse, particularly obviously for the importers. In terms of what the RBA would do about it, I don't think the RBA would do very much about it. In global currency markets, the RBA doesn't really have that much in terms of FX reserves to really move against that. So I think the RBA just has to take that on the chin, but also that would be occurring, if that were to occur, where the Australian dollar falls in a very subdued global growth environment. And so you would see a reduction in global demand, and that should also feed through to activity in Australia as well. So it'll be a fine balancing act between higher imported materials and also demand globally and also in Australia. And just very finally, in terms of the Australian economy at the moment, even with the headwinds of inflation and global growth risks, I'm still relatively positive in terms of the Australian outlook. As I was noting before, the unemployment rate is currently at 3.9%. Job ads indicate labour demand is still very, very strong in Australia. Job ads, according to Seek, I'm sure many of you have used the Seek platform to advertise for jobs, is currently 70 to 75% above pre-pandemic levels. So all pointing towards very, very strong labour demand. A lot of that is tied up with the international border. And what we have seen is the flows coming across the international border have been a lot slower than what we had expected, particularly for the students and also for the working holiday visas. So those skills shortages or worker shortages in hospitality and tourism are likely to persist for some time. That's very much tied up with China's zero COVID policy, and it's very hard for Chinese students to get out of China. And at least the indications are China's zero COVID policy is likely to continue for at least until the end of this year. So that's going to keep that labour market relatively tight. Where we are starting to see a little bit of easing up is in the highly skilled sector. There are some visa processing issues at the moment, but once that gets worked through, we should start to see a little bit of easing up in the highly skilled area in terms of the labour market. And just very finally, just to illustrate that households overall are still in a very good shape. Households since the pandemic began have accumulated about 283 billion in cash deposits sitting in the banking system. That can absorb some of that higher inflation, and indeed it's part of the reason why firms have been able to pass on higher costs. That should also be able to absorb to a degree some of the high interest rates that are likely to come from the RBA. And importantly, should continue a relatively strong going forward as well. I appreciate in today's presentation, I have covered a lot of ground. If I was to reiterate the three key points is the RBA is expected to continue to lift rates. We expect a 50 basis point rise in August, and we see the RBA cash rate getting to a peak of around 2.6%. We have that peak sitting in 23, but the risk is that the RBA wants to get to that kind of 2.6% level a little bit earlier. So that could occur in 2022. We still struggle to see the RBA cash rate lifting as far as the market is pricing at the moment, primarily because of the impact it would have on the household sector in terms of interest servicing and also in terms of the housing market. And just finally, in terms of global markets and in terms of market rates, you are starting to see a bit of consolidation occur due to those fears of global recession. I'll leave it there. Thank you very much for your time, and I'll pass it back to James.
Thanks, Tab. It's a terrific presentation and a great promo on this slide for the economic research and the morning podcast. When we send out the link to the recording of this presentation, we'll send out this information so that you can self-service if you want to get any of our research. Just a reminder about the Q&A. We've currently got a handful of questions, a small handful of questions in there. Just pop your question in the Q&A if you'd like to ask anything. The first question is for Ethan, and the question is, in your recent client interactions, what sort of activity in response to the recent rates moves are you seeing?
Thanks, James. Yeah, so just to kick off as well, I mean, this webinar is targeted at our regional agribusinesses across New South Wales. So, you know, there's a lot of you doing it probably pretty tough in the rain out there, so I appreciate you dialing in. Client interaction. So we've been having lots and lots of client interaction, and a lot of it is, you know, what's going on, seeing our rates starting to rise. So, for example, the majority of people on the call may have a corporate markets loan or a business markets loan, which is tied to our quarterly BBSY. So we've seen that move, you know, close to 1.5% in the last 2 or 3 months. So from your last scroll period, you would have seen your rate rise by that amount. When we're having a conversation about fixed rates and you know the outlook for where we are, as Tapas has mentioned, the market pricing has gone completely significantly higher. So you're having that conversation around where we currently are, where the market's pricing, and where the fixed rate pricing has been. So the reaction, to be honest, James, has been, wow, I didn't see that coming, or these rates are, you know, incredibly high. Are we really going to get to that sort of level? And that's been the conversation around, well, that's where the market's pricing it. Market has not been wrong so far. They took on the RBA's call of not lifting rates till 2024, and they've obviously done that earlier. What's happened in the last couple of weeks, probably the toughest point as well, is swap rates have come off about 1%. and we have seen the global growth concerns really start to eke in. So a lot of clients are having that reaction that, yes, this may be temporary, but, you know, as Tapper said, we may slow down towards the back end of 2023, 2024.
And so what, from a strategy perspective, what sort of strategies have you been seeing?
Well, over the last couple of years, a lot of our clients have taken fixed rates at really low levels for a longer period of time. So as Tapper's mentioned, that the share of fixed rates is traditionally quite low in Australia, sort of around that 15, 16, 17%. In COVID, correct me if I'm wrong, Tapper's, it got up to sort of 40% and is now sort of slowly working its way back down as that spread. So from a strategy point of view, that instead of clients coming in and you know, hedging or fixing a larger percentage of their debt, they're looking at doing smaller amounts. So I think it's averaging in as volatility is so high. It's taking some protection rather than you know, doing it all on a fixed rate or 50%, which would have been, you know, traditional clients' strategy there.
Very good. Couple of questions here that sort of interrelated a little bit about the RBA and being able to get inflation under control. So this question here sort of says, isn't it true that we may not see inflation improve even if we continue to raise interest rates? Are the majority of our issues spending outside of our control, rising costs like Ukraine, floods, lack of supply, etc.? So will the RBA, like they did in New Zealand, realise that they might not be able to get inflation under control, or will they continue to do that?
It's a very good question, and many aspects of the inflation that we're seeing is definitely out of the purview of central banks, particularly in terms of Russia and Ukraine, and domestically in terms of the flood as well. For inflation, that's the change in the price level. So as long as those things don't intensify and the prices don't keep rising, then you will start to see inflation stabilise. But I appreciate for most people, that will be a stabilisation of prices that is still very, very high. So at least from the RBA's point of view, if they can ensure inflation expectations don't rise, and if people don't expect inflation to keep increasing by 5% a year, then inflation should stabilise, just given that the oil situation, the food situation isn't likely to intensify further in the respect of prices going dramatically higher from here. So that's the confidence behind the RBA's view that once they start hiking rates, that will start to put a bit of downward pressure in terms of inflation. The other aspect of it is a fair chunk of the inflation that we have been seeing is actually due to a lot of the pandemic effects that are actually within our control. So the first one is during the pandemic, obviously we're in lockdown, we spent a whole heap on goods and also on renovating our homes and also purchasing new homes as well. You're starting to see retailers, particularly in the US, with excess inventory levels, and they're starting to clear those inventory levels. So you're actually starting to get some price reductions occurring in, say, white goods in the US, and you're likely to see some of that reduction also occur in cars as well, as people start to service higher auto loans. So, and that should reduce demand for that sector. The other interesting area is in terms of chips. I'm sure everyone heard about the semiconductor shortage of last year, and all these firms embarked on a whole heap of investment in order to increase production of semiconductors. And what we have seen is the major chip companies right around the world are now seeing a big change in demand, and they're actually going to be left with excess chips. So a lot of chip inventory at the moment as well. Our main reason for that happening is, and I did this during the pandemic myself, purchased a new TV, a new monitor, a new computer. People aren't doing that to the same degree again. So you are starting to see some moderation in inflation. That should help inflationary pressures ease. And indeed, in terms of those global freight rates, that's what that is also reflecting as well. Less goods trade occurring because of that rebalance away from goods. So, it does suggest that inflation should come back down. And at least in the near term, what central banks are worried about is the inflation we have seen gets embedded in the economy. So that's part of the reason why they've been relatively aggressive for that.
Okay. Someone's asked a question about the RBA and do they have any other tools to combat inflation? Obviously, they have rhetoric or strong language is another tool, but what else do they have in their kit bag to control inflation?
They don't really have too much else. So in terms of their broad policy instruments, what they could do is obviously keep lifting the RBA cash rate. And the alternative one is they could actively sell down their balance sheet that they accumulated during the pandemic. So at the moment, what they are doing is they're allowing those bonds to mature and naturally roll off. But because they purchased within that kind of 5 to 10 year bucket, there's not much in terms of maturities until say 2027. So if for whatever reason inflation is not coming down and they need to tighten up financial conditions in Australia further, they could actively sell down that portfolio. So that's the other tool that they do potentially have.
From a fiscal point of view, Tavis, the new government, obviously, do you see them adding to inflationary concerns by big spending programs, or how do you see their governing, to try and keep inflation under control at the moment?
Yeah, so it's a very, very good question. And it's actually a question I get asked quite a lot at the moment is what can the government actually do and what will they do? Traditionally, Labor governments have been pretty high spending governments, and so that has added to the inflationary impulse. The exception is Kevin Rudd's government back at the start of the GFC, when a lot of people were saying the inflation genie is out of the bottle. They had relatively restrictive policies, and that was also combined with the RBA as well. So it's not unprecedented for a Labor government to rein in spending in reaction to inflation going on. And I know a lot of public servants in Canberra are advising the government that they need to be very careful in terms of spending commitments, just given inflation. The other aspect of it as well, and this goes to what's going on in US politics at the moment, inflation is very visceral. And I think the Labor government will be very cognizant that if they don't do something, or at least appear to do something, to get inflation down, then they're going to be gone at the next election. So it's also within their own political interest to do something about inflation. So we're not expecting the October budget to be a big spending budget at all. We're also expecting the October budget to lay a little bit of groundwork, a little bit of consolidation, so the RBA doesn't have to do the work in terms of getting inflation.
And that directly leads to a question here. Where do we see the inflation rate peaking? 11 to 17% like Europe. Many businesses are trying to renew leases and think they could be signing up to business debt straps. Is that something you would have a view on?
Yeah, so our former forecast see headline inflation in Australia peaking around 7% and peaking at 7% in the fourth quarter of this year. And thereafter, getting gradually back towards that kind of 2 to 3% level. Importantly, that will be contingent on two things: inflation expectations remaining anchored, and the other one is, and I was talking about earlier, is those global forces on inflation starting to reverse out. If for whatever reason you don't see a reversal out of those global inflation forces, and maybe the peak is a little bit higher, and maybe inflation is a little bit more persistent. But if you do see those global forces start to come out, then you have greater confidence that inflation is going to head back down. And I'm sure in subsequent webinars we'll be giving various updates in terms of exactly where the global inflation trend is.
Very good. Just changing tack a little bit. Richard Hudson's just requested an outlook for ag commodities in general. Prices have created recently, but input costs are still rising. Do you have a bit of a view there on the outlook for ag commodities in general?
You'd have to say at the moment, looking at the weather forecast, probably going to be another pretty rainy season in Australia. They're tipping a 50% chance of La Nina occurring in our summer. And historically, that has also meant drought conditions in many other parts of the world. So I think you are still going to have a relatively tight market in terms of the agri sector. And for the Russia-Ukraine conflict, I think that is still going to persist for some time. So that's also going to be an area where you may get a little bit of softness is in wool and in cotton, obviously. If we are going to a global recession, there's going to be less demand for those products. But at least in terms of the soft commodities, I think they are still going to be relatively tight, just given if we do go into La Nina in Australia, the rest of the world is going to be in trouble.
A question from Will. How real are concerns that a wage spiral similar to the 70s will take place?
It's another very, very good question. And I guess a lot of people are thinking about that at the moment, especially given that the Fair Work Commission gave a minimum wage rise of 5.2% and award rises of about 4.6 to 5.2. You just have to pick up a newspaper and you can see New South Wales public servants on strike. They are definitely campaigning for inflation-adjusted wages. So there is definitely a risk, but the central bank is doing all it can in order to minimise that risk. And the key difference to the 1970s to now is the commitment of central banks to get inflation down. In the 1970s, central banks were more aligned with politics and the political cycle. And you can clearly see that through where inflation got to in the 1970s, where the Fed funds rate was in the 1970s, and the debate that were occurring around the Vietnam War and what the central bank had to do in order to help fund the US government. Do that. Fast forward to today, all the talk is about central banks need to get inflation under control, in order for the electorate to be more content with the government that they have. That's at least the narrative in the US. So I think the danger of a wage price spiral is a lot less than it was in the 1970s. The other factor is the rate of union membership in Australia is a lot less. So organised labour campaigning for higher wages will not have the same effect as it did in the 1970s. And indeed, most of Australia is under those kind of individual agreements. So in regards to that, then it really depends on how tight the labour market is rather than exactly what the
What's that been put down to? Lower union membership?
It's been a trend decline since the 1970s. Very different factors. So an erosion of how much power a union has in terms of who gets hired into the organisation. A general rise in living standards, particularly in regards to technology and lower inflation, especially coming out of China, the export of very low cost goods there. So that outsourcing of the manufacturing side helped drive lower union membership right across the developed world. So when you look at those kind of charts on union membership, has absolutely plummeted.
On that outsourcing to China, I mean, it's been a bit of a common theme with COVID and supply chains that some of our clients are actually looking to manufacture onshore, to bring stuff back, to Australia. What do you think that does for inflation and a changing of sort of the secular trend of inflation being kept low over the last 20 years? Do you think that shifts it, or do you think there's any other changes with that?
But it's another very good question, and what we are seeing is a little bit of reshoring or onshoring, but predominantly what we are more seeing is diversification of supply chains away from China. But that doesn't necessarily mean bringing production back into your home country. It means seeking other countries that are relatively friendly towards your government. So what we have seen internationally is more companies going towards Mexico, going towards Vietnam, Malaysia, in order to get a more friendly jurisdiction and to get over a lot of the policy uncertainty. So it has a technical term, it's called friend shoring. And just to give you some indication of where Australia's friends are, just the three key agreements that we have signed over the past couple of years is AUKUS. So that's a security agreement between Australia, UK and the US. The Quad, which is another agreement between India, Japan, Australia and the US. And the other one is the TPP-11, which is the old Trans-Pacific Partnership, but obviously China wasn't in that. There are a number of different countries within that agreement in the Asia-Pacific region, particularly Chile, Vietnam from memory, and Indonesia. So I think those countries are going to be the predominant areas where companies diversify away from China. And then the second factor, and it plays to what we're doing here at the moment over Zoom in terms of the webinar, is I think more firms are opening up the potential to outsource services. And this is particularly relevant in terms of how tight the labour market is. So I was speaking to a number of different accounting firms recently, and because of the lost people to other companies, they tried to replace those workers but weren't able to. And so what they actually did was offshore that work. So they did it in two different ways. So one did it indirectly through an offshoring company in one country. Another person actually directly employed people in that other country. So I think the technology developments that we have seen, at least in the services side, suggests if you can work from home, your job can also be done overseas as well to some extent. So I think if the labour market remains tight, you'll probably see more firms thinking about the costs and benefits about offshoring from that as well. So I fully acknowledge some on the manufacturing side, there might be some onshoring, but also might be some offshoring on the services side as well.
Give you a bit of a break. A question for Ethan. For a business with high interest rate exposure, what strategies and tools should it use to manage the risk effectively?
Well, it's an interesting question because, as Tapas mentioned, and as you would know, with commercial interest rates, they're essentially based off the swap rate, which is higher than our BBSY at the moment. So, essentially, you are paying a premium upfront to have a known expense for a certain period of time. The way that you'd explain it is having an insurance premium or having a worst case rate. I think the key takeaway out of Tapas's and what we've been seeing in markets is you're seeing swings in swap rates and bond rates of 1% over the course of 2 or 3 weeks, which if you look at a chart over the last sort of 5 or 6 years, you'd be lucky to see that over a year. So it's incredible volatility, and there's an incredible amount of circumstances that could see that go lower, and inflation come off or go higher. So what I think it's really important for clients with debt exposure at the moment is to be really modelling what does that all look like for you and your business, and removing trying to pick the market, as the traders would do, and as the people who stare at the charts and the analysts try and forecast, but to see what would really hurt for your business, and at what sort of levels does the debt seem to become unsustainable, and then to come to talk to us. So we have swaps, which is a fixed rate. You have interest rate caps where you pay a premium for a worst case rate. There is other option strategies as well that we can look at. If you're in a really fortunate position where you can handle really high interest rates and you've got a really solid cash flow, taking that higher fixed rate, might not necessarily mean a lot to you at the moment, because you can ride out the cycle. But not everyone's like that. So the big corporates have got treasury policies for a reason. They need to hedge a certain amount for a certain period of time, and that's because of for events like this and unforeseen circumstances, and the ability to account and to budget for your next spending. You're going to hopefully come back and borrow more and buy another property or another farm, or grow the business in some way, and having that certainty of what the debt's going to cost over the next 3 to 5 year period is really important for some businesses. It gives them the certainty to go out with the budget and a forecast and to borrow more and to continue to grow the business. So we have lots of different strategies. We sit down with you guys and talk about rates, obviously, but also about the forecast for the business and your intentions. If you're looking to sell a property and clear your debt, well, you obviously wouldn't be looking at taking a long-term fixed rate. But if you've many in the R&A sector here, you've got long-term debt profiles. It's a bit different to maybe your inner cities, which have commercial properties with short-term leases, and it's very year by year, whereas you guys have the fortunate ability to take a long-term view. And historically, rates, while they are a lot higher than where we were 2 years ago, they're not necessarily, very high. I'm sure many on the call would have seen bigger debt cycle, bigger rate rise cycles than this, and certainly myself. So.
Very good. Probably just mindful of time. One more question for you, Tapas. Is there an expectation that US earnings are being impacted, and what influence will that have on the Fed's rate path?
That's another good question. In terms of earnings being influenced, we haven't really seen too much in that way. The only aspect we really got was in the last reporting season, particularly amongst the retailers who were reporting very low inventory levels and stabilising or declining sales. So the upcoming earnings season is going to be quite important just to see whether what the market is fearing is actually starting to be reflected in earnings or not. So maybe best to answer that question in a couple of weeks' time. But in terms of how that would impact the RBA, there'll be a lot to do with how companies actually react to a lower earnings profile. If they stop hiring, if they start doing more retrenchments, then that could potentially ease up some of the labour market tightness that we have seen, and potentially mean rates don't have to rise. So we'll be looking quite closely at the upcoming earnings season, exactly what companies are seeing in terms of earnings, but also in terms of what they're doing in reaction to those forecasts.
I think we'll close it out there, and thanks everyone for your time. I appreciate it. What we will do is send around the link with the recording and obviously some other information around our research and data. I think just to reiterate Ethan's point, that if you've got concerns about riding the cycle and how the volatility is affecting your debt profile, then you certainly should speak to your banker or speak to your markets risk advisor. This is something that we're able to do at any time. We're able to come and see you, whether you want to do it face-to-face, telephone, Zoom. We can do that and have a conversation with you about the risk and what strategies you might be able to put in place. Thank you, everyone. We'll leave it there, and all the best.